The call comes on a Tuesday, not a Friday, not a Monday morning, a Tuesday, which somehow makes it stranger. Your uncle's attorney is on the line and he's using words like estate, liquidation timeline, and step-up cost basis. And you are standing in the parking garage of whatever building you work in, and the concrete is cold, and something has just changed permanently, and you do not fully understand it yet. The number he says is $4.3 million. You say thank you. You hang up. You stand there. Most people think inheriting money feels like winning. It does not feel like winning. It feels like someone handed you a set of keys in the dark and told you the locks are somewhere in that direction, and then left. You are 31 years old, and you are good at your job. You pay your bills. You have a 401k you barely look at, and a savings account that makes you feel responsible without making you feel secure. And now, as of 11:47 on a Tuesday morning, you have $4.3 million sitting in a brokerage account attached to a name you need to transfer into your name, and every decision you make in the next 90 days will either compound for the rest of your life or quietly dissolve into nothing. This is what that actually looks like. The first thing the attorney tells you is not to move anything. The estate is in probate, which means the assets are technically frozen until the court signs off, a process that takes 60 to 90 days depending on the state and whether anyone contests. During that window, you are not an investor. You are a beneficiary. There's a difference, and it matters. Because the decisions you make before probate closes are about structure, not allocation. The step up in cost basis is the first thing a financially literate person explains to you, and it is genuinely one of the most valuable mechanisms in the American tax code. Whatever your uncle paid for his assets, the stocks, the real estate, the partial interest in a private company, does not matter anymore. The cost basis resets to the fair market value on the date of his death. If he bought 10,000 shares of something at $12 per share and it's worth $43 per share today, your inherited basis is $43. If you sell immediately, you owe almost nothing in capital gains. Most people don't know that. Most people inherit and hold out of sentiment and pay taxes on decades of appreciation they never needed to carry. You have a 90-day window where your tax situation has never been cleaner. That window closes quietly and without announcement. The second call you need to make, before the attorney, before the accountant, before anyone who is going to try to sell you something, is to a fee-only fiduciary, not a broker, not a wealth manager at the bank where your uncle held the accounts. A fee-only fiduciary means they are legally required to act in your interest, and they charge a flat fee, not a commission. The distinction is not subtle. A commission-based advisor makes more money when you buy more product. A fiduciary makes the same money regardless. That structural difference shapes every conversation. The financial industry has $4.3 million reasons to find you in the next 45 days. This is where most people make the first mistake. And it is not the mistake you think it is. The mistake is not velocity, moving too fast because the money feels temporary, because holding it feels like not doing anything, because every person in your life suddenly has an opinion, and the pressure to act, to show the money working, becomes indistinguishable from wisdom. Slow is the move. Your first meeting with the fiduciary covers one question only. What does this money need to do? Not what does it need to return, what does it need to do? That question has a different answer for a 31-year-old with a salary and no dependents than it does for someone who needs this money to replace income. Your allocation, your liquidity structure, your tax strategy, all of it flows from the answer to that one question. If you skip it and go straight to where should I invest, you are optimizing before you have defined the goal. The financial industry loves it when you do that. It keeps you busy and it keeps you manageable. The equity you inherited, the partial stake in the private company, is the most complex piece and the one most people ignore because it does not look like money. It is an illiquid minority interest. You do not control it. You cannot sell it easily, but it generates distributions. It sits on a cap table, and it has real value that needs to be understood before you make any structural decisions about the rest of the estate. You sit across from the estate attorney in a conference room on the 14th floor. The folder in front of you has blue pen annotations in the margins, not highlights, annotations, your uncle's handwriting. He says he thought about you when he structured this. You don't say anything for a moment. That sentence rewrites the last 3 years of a relationship you took for granted, and you feel it in a way that has nothing to do with money and everything to do with it at the same time. 90 days from now, the accounts are in your name. The step-up basis has been documented. The illiquid stake has been appraised. The fiduciary has built a structure, not a portfolio, a structure that separates your liquidity needs from your growth capital, from your tax-deferred assets. The number is still $4.3 million, but it is not the same $4.3 million it was in the parking garage. You understand it now. Somewhere right now in a probate court in the Midwest, a clerk is processing another estate. The beneficiary is standing in a parking garage or a kitchen or a hospital corridor. The attorney just said a number. The beneficiary said, "Thank you." They have no idea what comes next.